Welcome to StokTok's deep dive into Moodys Corporation. Moodys is a leading global provider of credit ratings, research, and analytics for institutional capital markets. As of May 5th, the stock is trading at $454. The stock has a 52-week high of $546 and a low of $402. The Relative Strength Index, which measures momentum on a scale of 0 to 100, sits at 52.1, indicating neutral momentum. The 50-day moving average is $448, while the 200-day moving average stands at $481, suggesting the stock is trading slightly below its longer-term trend. Let's work through the fundamentals, scene by scene. Starting with a quick business overview. Moodys generates revenue through two primary channels. First, the company rates debt instruments, bonds, loans, and structured products, providing institutional investors and regulators with a standardized assessment of credit risk. Second, Moodys operates a research and analytics business that sells subscriptions to institutional clients seeking intelligence on capital markets, credit trends, and economic conditions. The company's competitive moat rests on the capital requirements regulators impose on banks and insurance companies to hold ratings from recognized agencies, creating high switching costs and recurring revenue streams. Moody's StokTok score is 55 out of 100, classified as a hold. The company scores 0 out of 20 on valuation, indicating significant premium pricing relative to intrinsic value. Financial health scores 16 out of 20. Profitability rates 19 out of 20, reflecting exceptional margins. Growth scores 12 out of 20, signaling modest expansion. Smart money allocation scores 8 out of 20, suggesting tepid institutional buying momentum. Now, valuation. The question every investor has to answer: are you paying the right price? Moodys trades at a price-to-earnings multiple of 32.47 times on a trailing 12-month basis, meaning investors are paying $32.47 for every dollar of annual earnings the company generates. The forward price-to-earnings multiple, what Wall Street expects looking ahead, is 27.14 times. The price-to-earnings growth ratio, which adjusts the earnings multiple by growth rate, stands at 3.81. Generally, a ratio above 2 suggests the stock may be pricing in significant future growth expectations. The enterprise value to EBITDA multiple is 21.55 times, and the price-to-sales ratio is 10.31 times. These are all elevated readings relative to historical norms for the capital markets industry. In our view, Moodys enjoys a durable competitive moat rooted in regulatory capture. The company is a nationally recognized statistical rating organization, a designation that creates high barriers to entry and locks in recurring revenue from issuers who must obtain ratings to access capital markets. This moat supports pricing power and consistent profitability. However, the current valuation reflects substantial premium pricing. Our discounted cash flow model suggests the stock is trading at a negative 69.09% margin of safety to intrinsic value. In other words, the stock would need to fall by approximately 69% for our fair value estimate to be reached. This is a significant premium. Wall Street analysts have a consensus mean price target of $535, derived from 20 analysts covering the stock. High estimates reach $610, while low estimates sit at $460. A wide dispersion that reflects divergent views on the sustainability of current valuation multiples. In Q1 2025, Moodys reported earnings per share of $3.56, beating the consensus estimate of $3.39 by about 5%. Revenue came in at $2.08 billion, though the headline revenue missed relative to the $8 billion estimate warrants context. The revenue estimate may have been an outlier. Year-over-year, revenue grew at 10.1%. Operating income reached $950 million, and net income came in at $660 million. The company maintains exceptional operating leverage, with the operating margin translating to meaningful earnings accretion. The market reaction was muted. The stock fell only 0.1% after hours, suggesting investors viewed the results as in line with expectations despite the earnings beat. Market sentiment around Moody's leans neutral, with broader macro concerns about stagflation and economic bifurcation, offsetting positive signals from steady financial market activity and corporate earnings reporting. Valuation here is stretched, in our view. While the business quality is undeniable, new investors are paying a significant premium for future growth that has not yet materialized. Moving to financial strength, how solid is the foundation? The Piotroski F-score is a 9-point checklist that evaluates balance sheet health, profitability, operational efficiency, and capital allocation. Moody's scores 8.0 out of 9, which is exceptional, indicating strong financial governance and operational discipline across virtually all dimensions. The Altman Z score, a model that measures bankruptcy risk by evaluating profitability, leverage, liquidity, and asset quality, stands at 7.22. A Z-score above 2.99 is considered the safe zone, and Moody's sits well above this threshold, suggesting very low bankruptcy risk. On the liability side, Moody's carries a debt-to-equity ratio of 2.44, indicating the company has about $2.44 of debt for every dollar of shareholder equity. This is elevated relative to some peers, but not unusual for a mature, cash-generative business. Cash to debt stands at 0.21, meaning cash represents about 21% of total debt, a modest ratio that reflects the company's reliance on debt financing rather than cash reserves. However, interest coverage, the ratio of operating income to interest expense, stands at 12.88 times, indicating the company generates operating income nearly 13 times greater than its annual interest obligations. This is a strong ratio that shows Moody's has ample capacity to service debt from operational cash flow. The current ratio, a measure of short-term liquidity, is 1.16, meaning current assets cover current liabilities by just over 16%. This is adequate but not lavish, suggesting the company relies on operational cash generation to fund working capital rather than maintaining large cash balances. Overall, the balance sheet is solid. While leverage is noticeable, the company's cash generation and interest coverage are more than sufficient to support the debt load, and the risk of financial distress is minimal. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, measures the profit generated on every dollar of capital the company has deployed in its operations. Moody's return on invested capital is 21.36%, which is exceptional. For context, many capital-intensive businesses target a return on invested capital of 10 to 12%, and Moody's exceeds that by a wide margin. This reflects the asset-light nature of the business. Credit ratings are generated by intellectual capital and brand, not by heavy tangible asset bases. Gross margin, the profit retained after direct costs of producing the rating and research product, is 74.43%. This high margin reflects the fact that once a rating framework is built, the incremental cost of rating additional bonds or distributing research is minimal. Operating margin, which measures profit after operating expenses like employee salaries, technology infrastructure, and marketing, is 44.84%. This is an exceptional operating margin for any business, but particularly striking for a business that must maintain a large team of credit analysts and researchers to maintain its brand and rating quality. Net profit margin, the bottom line percentage of every revenue dollar that becomes earnings, is 31.69%. After accounting for interest, taxes, and other non-operating items, Moody's retains nearly one-third of every dollar of revenue as net income. Free cash flow margin, which measures the profit available to shareholders and debt holders after capital expenditures and working capital needs, is 34.89%. In Q1 2025, the operating margin was calculated at approximately 45%, consistent with the trailing 12-month figure, suggesting margins remain stable even as revenue grows modestly. This combination of margin stability and net income generation of $660 million demonstrates that Moody's is not just profitable. It is converting revenue into cash with exceptional efficiency. The business is a cash cow. Onto growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years averages 12.2% annually. Over the trailing 5-year period, the compound annual growth rate is 7.8%. This growth has decelerated over the longer period, suggesting the company is maturing. In Q1 2025, revenue grew at 10.1% year-over-year, which sits between the 5- and 3-year historical rates, indicating modest but not accelerating expansion. The company operates in a cyclical business. Rating volumes and research demand expand when credit markets are active and issuers are accessing capital markets, and contract during periods of financial stress or capital market dislocation. The modest single-digit to low double-digit growth reflects maturity in a largely saturated market, where Moody's maintains dominant market share. Book value growth. The expansion of shareholder equity over the trailing 3 years has averaged 18.4% annually, significantly outpacing revenue growth. This divergence reflects the company's ability to grow earnings faster than revenue, driven by margin expansion and share buybacks that reduce the share count. The dividend yield is 0.84%, indicating the company returns modest cash to shareholders through dividends, approximately 84 cents per $100 of stock price annually. The low dividend yield is typical for a growth-oriented company that prefers to retain earnings and deploy capital toward debt reduction or share repurchases. Management has not provided specific forward revenue guidance for the remainder of the year, but the analyst consensus for next earnings on July 23, 2026 points to earnings per share estimates of 4.19, with a range of 3.81 to 4.46. This suggests the market expects mid-single-digit percentage earnings growth from the quarter we just observed. Growth, in summary, is present but not spectacular. The company is expanding at a steady low double-digit revenue rate, but the bulk of earnings growth is coming from margin expansion and balance sheet optimization rather than organic revenue acceleration. This is characteristic of a maturing, high-quality business in a mature industry. Now let's talk smart money. What institutional capital is actually doing with this name? 20 top-tier investment managers currently hold Moody's in their portfolios, indicating the stock is on the radar of elite capital allocators. However, the data on capital flows tells a more nuanced story. Among 13 F filings submitted by institutional investors, only 7.0% are net buyers, defined as funds reducing their position size below 50% of their previous holding. This indicates that the majority of institutional holders are either maintaining positions or selling into strength. This split suggests the market is divided on current valuation and near-term direction. The top Guru holder is Valley Forge Capital Management, which maintains a position equal to 15.25% of their overall portfolio and has added 0.24% to their stake. This represents the most significant allocation in recent buying. Chris Hohn's TCI Fund Management holds a 12.67% position and has made no changes, suggesting a buy and hold stance. Chuck Acker's Acker Capital Management, known for quality at reasonable price investing, holds 9.72%, but has reduced the position by 18.11%, a meaningful trim that could signal concerns about valuation, despite the quality of the underlying business. Guy Spears Aquamarine Capital maintains an 8.71% position with no recent changes. Alta Rock Partners holds 8.16%, but has reduced by 14.15%. The pattern suggests that, while quality-oriented value investors remain bullish on the business, the elevated valuation is causing some of the smartest investors to take partial profits. Insider ownership stands at 0.73%, which is very low. Management and company insiders own less than 1% of the company, indicating limited personal capital is at stake. Over the trailing 3 months, there have been 0 insider stock purchases and 10 insider stock sales, suggesting that when company executives have the opportunity to buy or sell, they are selling. This is a bearish signal. It suggests that insiders believe the stock is fully valued or overvalued at current levels. Smart money is decidedly mixed, with iconic long-term holders maintaining positions but trimming slightly, and insider activity showing net selling. This is not a sign of institutional conviction at current prices. And finally, the verdict. Let's bring it all together. On valuation, Moody's is trading at a significant premium to intrinsic value according to our models, with a negative 69% margin of safety. The company is a quality business, but the market is pricing in growth that has not yet materialized. On financial strength, the balance sheet is rock solid with minimal bankruptcy risk and strong interest coverage. This is a fortress balance sheet. On profitability, the company is exceptional, with operating margins of 45%, net margins of 32%, and returns on invested capital exceeding 21%. Few businesses globally can match this profitability profile. On growth, the company is expanding at a steady low double-digit revenue rate, but this is modest given the valuation multiple, and the growth rate has moderated when looked at over a 5-year horizon. On smart money, the data is mixed. Quality investors hold the stock, but some are trimming positions at current valuations, and insiders are selling more than buying. The Q1 2025 earnings beat on earnings per share was encouraging, and the operating margin remained pristine, but the modest 10% revenue growth and the muted market reaction suggest investors have already incorporated these results into the stock price. Bringing it all together, in our view, Moody's is a wonderful business at a questionable price. The company generates exceptional returns on capital, carries a sustainable moat rooted in regulatory advantages, and converts revenue into cash with remarkable efficiency. However, valuation remains the limiting factor. New investors paying $454 are assuming significant multiple expansion or material revenue acceleration that we have not yet seen materialize. Existing holders of quality likely benefit from the economic moat and margin stability, while new money might find better risk-reward in peers trading at more reasonable valuations or in sectors where growth is more compelling. The setup, in our view, warrants caution. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Moodys Corporation. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.